Good afternoon. Here are the closing market comments for Wednesday, November 10th. Outside news was relatively quiet today, and corn and wheat prices did fall further following yesterday's disappointing close, while the soybeans gave back a little bit of yesterday's big gains. December corn finished 9.5 cents lower at 5.66 3/4. July corn down 9.25 at 5.93. January soybeans down 9.5 at 13.19.5, and July soybeans down 12.25 cents, finishing at 13.30 1/4. Kansas City December wheat down 14.25 at 7.72 3/4. Minneapolis December wheat down 13.5, finishing at 7.82. Outside markets were relatively quiet today and somewhat mixed as far as an influence on the grain markets. Crude oil is currently trading $1.01 higher at 87.73. The gold market is down about $10 per ounce at 1,400. The U.S. dollar index up 18 points at 77.76. And the stock market very quiet, with the Dow currently just 4 points lower at 11,346. Livestock markets had a good day with lower grain prices and higher futures. December cattle finished $1.20 higher at 99.40, while the December hogs were $1.70 higher, finishing at 68.25. News in the corn market was relatively quiet today, so let's take a few minutes to review some of the big picture items following yesterday's USDA November crop report. The lower U.S. ending stocks are near or even below pipeline minimums, and that means that the current stocks will only allow for 22 to 23 days of usage. This is near record tightness, and really there's no room for error right now with this U.S. corn situation. The 75 million bushel loss in stocks that we saw yesterday will also require an additional 500,000 planted acres next spring just to maintain the current tight supply levels. The world feed grain situation is also very tight, and this means that end users around the world have limited alternatives, especially when we look at rationing corn and switching to other possible feed ingredients. We will not have the luxury of another large U.S. corn crop for another 10 to 11 months. Since production can't improve the overall U.S. ending stock situation until next fall, any improvements to the balance sheets will have to come in the form of demand rationing. Taking a look at our U.S. corn ending stocks-to-use ratio, USDA lowered our ending stocks and therefore stocks-to-use ratio down to 6.2%. That's the equivalent of 22 to 23 days of usage, and typically the market figures that minimum pipeline supplies are around 30 days of usage, and that's one of the reasons why this marketplace continually discusses the fact that we're going to have to ration some of this U.S. corn demand. In soybeans, the lower U.S. ending stocks also at near or even below pipeline minimums, current stocks only allowing for 20 to 21 days of usage. The 80 million bushel lower stocks number requires nearly 2 million additional planted acres next spring just to maintain the tight stocks levels. So as we've discussed the battle for acres next spring, that battle has just become a little bit more intense due to yesterday's loss in stocks of both corn and soybeans. South American beans will become available to the world marketplace, at least in good volume, beginning in March of 2011. It's critical at this time that they have a very good growing season to prevent the U.S. shortage of soybeans becoming a worldwide shortage. U.S. exports and South American weather will both be very important in determining price direction for the U.S. market over the next 90 days. I've pulled up a chart that shows both the U.S. ending stocks as well as the stocks-to-use ratio. First of all, taking a look at stocks in the orange bar, we're down to 185 million bushels of stocks. If you remember, just 3 months ago, we were sitting with an estimate of 360 million bushels. So our ending stocks in the last 90 days have nearly been cut in half. Now looking at the stocks-to-use ratio, which is in the blue line, our stocks-to-use ratio for soybeans down to 5.5% in a stocks-to-use ratio. That is very near historic lows for the stocks-to-use ratio in soybeans. And again, beans have now joined the ranks of corn in having a supply and demand balance sheet that is extremely tight and has no room for error. In the wheat market, Egypt did purchase 235,000 tons of wheat here overnight. A good chunk of that came from the U.S., 115,000 tons out of the U.S., 60,000 French, and 60,000 Australian. So it's good news for the U.S. export market to see Egypt picking up some of its purchase in U.S. wheat. Wheat was the market leader of the grains last summer due to the drought in the FSU and the Russian export ban. Since early August, wheat has been riding the coattails of the corn market, and this will likely continue into the winter as the corn supply and demand balance sheet is extremely tight, with wheat supplies just a little bit more available. Feed wheat is relatively cheap compared to most feed ingredients around the world, and this is likely to result in increased world demand throughout the winter months. Taking a look at the December corn chart, corn is having its first major correction now over the last 3 weeks. Technical indicators also having their first significant setback of the last 3 weeks after trading very near the overbought level throughout most of October and into early November, now correcting downward. Over the last month since the October crop report was released, corn has been in a gradual uptrend, and that uptrend actually is still in place. We still have all of our moving averages pointed in an upward direction, and they're still in line. The next level of support would come in at that trend line, coming in right around the 560 to 565 level, very close to our lows today. And strictly from a chart perspective, if that line were to be broken, there's probably a lot of chart traders that would be looking at the 542 level that was the lows posted back in mid-October. We are hearing talk from some analysts that the major reversal that took place in yesterday's market with follow-through today could be signaling a major top. Right now, I'm in the camp that this is just a correction in an overall uptrend. The supply and demand situation is so tight in corn and has now been joined by some extreme tightness developing in the soybean market that I think we're going to find some pretty significant buying. That doesn't mean we couldn't correct further down into that low 560 area or possibly on an outside chance down towards that 542 level. But I do believe that over time, into late November or into December, that this market will bounce back, and I am still looking for new highs to be posted in this market yet before the December contract expires. Turning to our January soybean chart, soybeans have been on a very strong uptrend since the October crop report was released, and yesterday's November crop report just reinforced the overall uptrend. But in any market, you cannot go up every single day, and soybeans could very easily have a correction back down towards the support of the trend line down in that 1270 to 1280 type price range, just in some corrective action. We do have to keep a very, very close eye on the South American weather, because if they would have any problems at all, this uptrend could be continued, and we could push above the previous highs of 1343. Looking down the road a little bit further, setbacks and corrections and profit taking can take place at any time. And so we're going to see a market that doesn't necessarily go up every day. But due to the extreme tightness in soybeans now, as well as the corn market, I do expect this overall uptrend to continue. And it does appear that prices will eventually take out the 1343 highs from yesterday morning, as I think that this market's overall trend will continue to work higher as we move into the winter months, especially if we have problems with South American weather. Turning to the Kansas City December wheat chart, with corn correcting, wheat is also correcting to the downside. We're now approaching significant support at the trend line that's drawn off of the lows back from June last summer. This trend line has been very supportive on numerous occasions on the way up, and unless corn continues to work lower, it would appear from a chart perspective that wheat would find good support again at that level. In our opinion, wheat is going to continue to be mostly a follower to the overall trend in corn, and since we're looking for corn to still make new highs as we move further into the winter, I think that the wheat price will continue on its overall upward trend and eventually work towards that 837 high that was posted back in early August. We are going to have corrections and setbacks from time to time, but the overall trend, I think, will continue to be in upward direction following corn. That'll wrap up this afternoon's broadcast. Thanks for joining us, and have a good afternoon.